Hey guys, welcome. Today is my first episode of Investing Questions Answered. This is a podcast series on finance that I am using to supplement my blog at Beyond Life's Adventures. And the website is in the description below. If you want to check it out, please do. The first question is there a chart that tells you which company pays you how much dividends? Your investing platforms such as Fidelity, Vanguard, Schwab, if you go under research or market research and you search for a company, for example, at Schwab, you can go to research and type in a company name like Apple, and it will show you everything about Apple, like the charts. You can configure the chart and add when the earnings were posted, the dividends were posted. You can look at it that way. Or you can go to nasdaq.com, look for the company there, and go under dividend history. You can also subscribe to Morningstar, but it's a paid subscription. Be careful selecting stocks based on dividends. Always stick with the fundamentals of the business. Another thing I want to add about dividends is that you have to be careful to not over concentrate your portfolio on certain companies, because what happens is that you choose a certain company that pays really great dividends and you saw that, wow, they've been paying dividends increasingly over 25 plus years or 50 plus years without any breaks, even though they've gone through all these recessions. They're so healthy, they're able to afford all this stuff. But if you think about it, you make sure that you have that investment there and it's a small chunk of your portfolio, because having a big chunk in that company can concentrate your portfolio on a certain sector of the market, and it makes your portfolio more volatile. So for example, if you have investments in housing or real estate that pays dividends, and most of these real estate companies, they pay monthly dividends. And if you are, during the recession, the housing market downturn, that would have sucked if most of your investments were in housing, right? So it's basically a reminder to diversify your portfolio. Okay, next question. Which online has lowest transaction fee, or should I use the one I already have, like Vanguard, for investing? Vanguard is actually a really good one. So I also have Vanguard, and I like all the big three. I call them the big three. I like Vanguard, Fidelity, and Schwab. I do notice that Vanguard has the cheapest expense ratios, basically the cheapest fees out there. If you are just buying index funds or index ETFs or stocks, then I do prefer Vanguard. If you already have holdings in Fidelity, Fidelity is great too. If you are using options or just trading in general, Schwab, I think, is the best because it caters more to traders. And I say that as an investor. So I do believe that options trading can hedge your portfolio, but please do not mistake trading as a quick way to make money, because you can actually, I don't want to how do you say, trail off into a different subject, but trading options can also be risky, but you can make it conservative. But this is going to be on another topic. We're not going to cover this right now because that's way, I've just gone way off tangent here. Is investing $50 a month realistic? for the fees and the amount to make? Or should I be investing more than $50? I think you should invest what you can. So the nice thing about this is that nowadays platforms like the big three allow for fractional shares. So even, for example, you want to buy the S&P 500 SPY or VOO, and they're really expensive right now. Like VOO is over $500, but if you have $50, you can buy a fractional share of VOO. One thing I want to cover is that if you don't have a certain amount of money in an account, and I can't remember the exact stipulations, okay, but it's if you don't have a certain amount in a brokerage account, some platforms, if not all, would charge you a fee to maintain it. Now, I don't remember how much this is, but my solution to this is that if you really want to avoid that fee, then you can put you can put your $50 or whatever amount into a high yield savings until you accumulate a significant amount. So you guys have to look at that when you sign up for a brokerage account to make sure if you are paying maintenance fees. If you put enough money, they would waive it. And since I'm talking about fees, I just want to let you guys know that actually Vanguard started instituting if you close your account with them, they will charge you a fee as well for closing or something like that. I thought that was news to me. I read about it. I did not do it. But I just want to let you know, before you dive into any institution, please read everything. I just wanted to add that mutual funds have always had fractional shares. So if you wanted a stake at VOO and for some reason the platform doesn't offer fractional shares, then just get the VFIAX, which is basically the mutual fund version of VOO. Another thing I want to say is that your mutual funds investments, if you want to get a mutual fund from Vanguard, buy it from Vanguard. Do not buy Vanguard mutual funds at Fidelity or Schwab, because when you buy mutual funds from another company but on a different platform, you will pay a fee, and it's usually $75 per I can't remember if it's per transaction, but I know you have to pay and it kind of sucks. So sometimes it's nice to buy ETFs instead, exchange traded funds, because you can do that without those fees. But some people prefer the mutual funds. Again, I don't want to go off on a tangent of ETFs versus mutual funds. We can do that at another time because I don't want this video to be too long. So let's move on. Do you check every 6 months and consider to hold your investments for the next 6 months or to sell them? When I buy an investment, I really hope to hold it forever. It's just less headache for me. So before I even dive in, I try to research a lot about the company and how they're making money and who's managing, like house management, cash flow, all these stuff. So I don't like to have to sell my investments right away. I don't want to buy and sell short term. My key idea of investing is so that I can take my time back. I brought investing into the forefront of my life so that I can actually utilize my time the way I want to. And I do not want investing to take over all that time. I want to be able to invest do my research, do all the front load hard work, and then check them from time to time. The only reason I would sell them is if the fundamentals of the business has changed. All of this digging and researching, all of this stuff, it already takes a lot of time. So imagine when you are buying and selling, then pick another one and do all that. That's adding more work for you. Also, taxes. When you sell your shares less than a year, you incur earned income tax, which is usually way more, a higher amount than capital gains. So capital gains is very, very cheap compared to earned income. I would suggest that you guys keep your investments longer than a year. Of course, you can sell them anytime, but what I'm saying is that if life circumstances behooves you to sell investments, like you need the money to pay for medical bills, something like that, then yeah, of course, sell it. But don't just buy and sell and buy and sell. This is not a great idea. Are reinvested stocks or ETFs taxed? Well, it depends. So if you have, it depends on your account, really. If you have a tax advantage account, then it doesn't. But if you have a taxable account, then of course it does. We already covered the first half of taxes, which is basically the capital gains versus earned income depending on your holding period. Some investments, before I forget, are called qualified dividends, while some are non-qualified. And just a quick overview, you can pretty much tell that they are going to be non-qualified dividends if they are from a limited partnership or from REITs. REITs are usually taxed as non-qualified dividends. So what that means is that when it is non-qualified, these dividends are actually taxed like earned income. So just so you know that not all dividends are taxed as capital gains. I just wanted to also kind of clarify this. Dividends are paid many different ways. There's quarterly dividends, biannual, semi-annual, or annual dividends. And if they're qualified dividends, even if they're paid quarterly, you are still paying capital gains on them. Now, when you sell the stock that's paying you those dividends and you've only owned that stock for 6 months, let's say, then you're going to pay earned income tax on that holding. If you wait to sell that stock that pays those dividends and you hold it for over a year, then the stock that you have sold after holding it for a year will be capital gains. Taxable brokerage account, you will pay taxes. If you have a traditional IRA, what that means is that everything coming into that account is pre-taxed. So from your paycheck, for example, and you set up a IRA account, traditional IRA, or a 401k, a 403b, a 457. They have so many names. They're all tax advantaged account. They are pre-tax. What that means is that if you get a paycheck, the gross amount of your paycheck, they take a certain percentage of that, whatever you had decided you want to put away, like maybe 15%, into that account, and you will not get taxed on that amount. So it basically lowers your tax bracket. And if you are making a lot of money according to Uncle Sam, which is not really fair to say with a lot of Bay Area employees, because Bay Area has really, really high cost of living. And we do get paid more than other states, but our cost of living is so high. It really is advantageous for you to max out your pre-tax, and we can talk about that in another episode as well. We'll cover retirement plans and all that other things. I wanted to keep this video short. Pre-tax, that means anything that's in that account, you buy, sell, it gets reinvested, whatever you want to do with it. As long as it stays in that account, it's all not taxed until you're required to withdraw it when you are, I think right now it's at 73 years old, required minimum distribution. Or some people leave their employers and wanted to cash out. Please don't do that. Don't do that. There's better ways to do with your money. When you leave your employer, do not cash it into your bank account. We will talk about that in another episode as well. If you want me to cover it, leave it in the comment section below. Do not do that, please, if you don't need to. That is such a negative thing for your finances. Anyways, Roth IRA is already taxed money. So it's the same thing with when you build your Roth IRA, everything that is getting into that account. So let's pretend this is outside the screen, and inside the screen is Roth IRA. I'm putting money here. There's a limit of how much you can put in there per year. It changes. And anything I put in here has already been taxed. I've already paid my taxes. This is after my paycheck has been taxed, and this is my net paycheck, and now I'm putting in money to fund my Roth IRA. I don't want to confuse you guys. If you have a traditional IRA and a Roth IRA, you can only max it out up to, I think it's 7,000 right now. I can't remember the limit, but if you are putting in, if you're allowed to put in 7,000, you can only put in 7,000 total from your bank account into the IRA. If you have a Roth and a pre-tax, it's 7,000. So you cannot do 7 and 7. If you want to talk about backdoor and mega backdoor Roth, we can talk about that at another episode. I don't want to make this too complicated. Just want to let you know, do not over contribute. You will get penalized. I think it's a 6% excise tax for as long as you keep the overage in your accounts. So Roth IRAs, you've already been taxed. So now the money that's in there is going to be tax-free. And that's why I love Roth IRAs. I have a few articles about Roth IRAs in my blog. I just love them. One caveat is you have to be employed to put money in a Roth IRA. You need to be earning a paycheck. Okay, I hope that's clear. And if you still have any questions regarding what I just said, please let me know in the comments. I'll try to be more articulate with my explanations. I try to explain it as simple as possible because I know that financial lingo and just finance for a lot of people is confusing, and I feel like they make it that way so that a lot of people just don't understand, but it's actually very simple. So I really hope that this episode helped you guys a lot, and if you did, please like, and hopefully you guys would subscribe. And also you can visit my blog at Beyond Life's ADV at Blogspot. The link is on the description below. And that's all for today. I'll see you guys at the next one. And thanks for being here for the first one. Bye.